So the month of November ended up with pretty strong results in both the stock market and bond market, and dare I say, better results than in most recent months. So is it that the worst is over, or is this just a calm before the storm? Stay tuned to this week's episode of the Retirement Income Source, where it's all about the income. And welcome to Retirement Income Source, where it's all about the income. I'm David Scranton, here with my good friend and co-host Sarah Samuels. And today, we're talking about the returns that we've seen in the markets in the month of November. Will they continue, or is it just a calm before the storm? And most importantly, what types of decisions you should be considering when it comes to your hard-earned dollars? Well, Sarah, good to see you again.
Dave, it's great to be here with you and with all of our listeners, of course, as we talk about this important topic, because really the Fed has pretty much signaled, they're going to be done raising rates. We know that the markets have reacted to this. We've seen long-term interest rates have dropped a little bit, as well as the 10-year government bond dropped a little bit under 5%. I think it was around 4.3%. So, Dave, what does this really mean for everyone?
This is all business to you, isn't it? I thought we were friends.
Well, we are, Dave. I get so excited about our show.
Sarah, I haven't seen you because we played a rerun Thanksgiving weekend. How was your Thanksgiving?
I didn't even ask about your Thanksgiving, Dave.
I know.
How was it? I'm sorry.
Well, my feelings are kind of hurt now, so I don't want to talk about Thanksgiving because you didn't ask me, so you don't really care. But I care about how yours was. So how was yours?
Oh, it was nice. It's always good, I think, to spend time with family and with friends and to reflect on things and what we're grateful for. And one thing I'm grateful for, Dave, is doing the show every week with you and getting all this important information out to our listeners.
All right. It's getting thick in the studio here at the Retirement Income Source. So, what does it mean with these interest rates, you asked? And that's a great question. I think it's right. The Fed hasn't really said there aren't going to be any interest rate hikes. But the market is interpreting it. In fact, a lot of the big investment banks came out just in the past week, and they're kind of arguing. They say, gee, by the end of 2024, are the federal funds rates going to be down to 3.5, to 3, to 2.5? Well, right now they're at 5.37, Sarah. And, none of the banks are coming out, none of the big names are coming out saying, hey, it's going to stay at 5.37. So it looks like interest rates will come down. In fact, we saw the yield on the 10-year government bond. Like we always talk about the 10-year government bond as being the longer-term interest rate, right? And we saw that come down. That was pushing close to 5%, and it actually got down and stayed down below 4.5. So it's proof that at least the markets are taking this as a signal that the Fed is done hiking. And that, at least in theory, should be a good thing for the markets in general.
Right. Well, the interest rates are not just affecting the stock market and the bond market. We're also seeing some effect potentially with real estate. And that has to do actually with our next Ask Dave question. Okay. This just came in actually earlier, just a few minutes ago, from Kyle in North Carolina. So, Kyle, thank you so much for listening to our show. And hopefully Dave can help you here. So, Kyle says, how do interest rates affect real estate values? Great question.
Yeah. Well, Kyle, interest rates affect pretty much all financial assets, real estate as well as stocks and bonds, where when rates are going up, it creates a headwind for the values of those things. When rates are going down, it creates a tailwind for those types of things. So you might think, okay, if rates are coming back down in the next year, that's real estate just going to keep going up. And, it may or may not, Kyle. There are some issues we have right now with real estate, and I'm talking about residential real estate. First of all, why have the prices stayed so strong even when interest rates are going up? Well, Kyle, a lot of it is because people have mortgages at 3%, at 4%, and when rates went up to 8%, they don't really want to sell, right? So you have this, all pricing has to do with supply versus demand. So when it comes to residential properties, there's been a limited supply of properties on the market for sale. Why? Because again, people are holding on to their homes, even if they want to move. Well, heck, for me to move, if I have a mortgage at 3 or 4%, now I'm going to have to pay 8. Do I really want to do that? And to make it worse, in some places, like here in Florida, gosh, I'm homesteaded, which means if I were to sell my house and buy the same house back, I pay twice as much in property taxes. So this has kept things artificially elevated. Now, the question is, when rates go down, is this going to push things up even more? Well, it's interesting, Kyle. It could push prices up for people who are trying to get in anew to homes or trying to buy a second home. But frankly, mortgage rates got to get back down in that 4% range, I believe, before things start to slow down. Because ironically, when they go down that far, I have a feeling that now all of a sudden more people might be selling their homes and might be making moves. And, that's when the supply of real estate on the market starts to expand, and that's when prices could soften. So we might actually see even a continual increase in values up to a point as rates start to drop.
Well, Kyle, thank you so much for sending in your Ask Dave question. And if any of our listeners or even our YouTube viewers have a question that you would like Dave to answer, even potentially on a future show, all you have to do is send us an email at askdave@retirementincomesource. That's SOURCE.com. You're listening to the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with Dave Scranton, and today we're talking about the markets over the past month. They've looked a little stronger than what we've seen in the past. We've seen the Fed sort of signaling they might be done raising interest rates, or at least a lot of banks have come out recently and kind of said that's what they're thinking the Fed is going to do. And really, most importantly, how the interest rates are going to affect your retirement. So, Dave, you just answered a question from Kyle about real estate. And you were talking about, not commercial real estate, residential real estate, people that are buying homes. What do you think about renting potentially in retirement versus buying a home, selling a home, or buying a second home?
It's a great question. And most people, though, who are about to retire own homes, right? So I guess the question is what that person's goal is, right? If you're looking to buy a second home somewhere, renting could be a great idea. And just having some patience to figure out, okay, wait till prices do start to come down at some point, because at some point things will level off or soften, right? Or maybe if you're just looking to move, right, to another area, then renting could be a short-term option, because you want to make sure you want to stay in that area, that you like the area, that's part of it, and what area within the area you want to be, what neighborhood. And also, especially if you're going to be taking a mortgage, it might give you an opportunity to hold off until maybe rates do come down and you can get a better deal. So that could make sense. But if you're just doing it for economics, to me, if it's let's say, let's take your parents, right? And if they get into retirement and say, well, I want to basically wager that real estate prices are going to come down. So I want to sell now because prices are high. I want to rent, and then I want to wait till prices drop and buy again. That's when it becomes a bit dangerous.
Yeah, it sounds like a gamble again, like you're hoping and wishing again.
It's a gamble because, again, I think the supply is going to stay short for a while. And if interest rates come down, I think, that could keep the prices going up. Yeah. And if interest rates get back down that 3-4% range on mortgages, then maybe there's enough supply on the market where that now allows prices to settle a little bit. Ironically, that could happen. Yeah. But again, it's certainly a gamble, and somebody who's retired really has to think about, is that a gamble that they want to take? Now, if there's other reasons, okay, let's say somebody wants to downsize in retirement because they've got 5 bedrooms, and heck, they don't need 5 bedrooms. That's a different story. That might be a good reason to make a swap.
Yeah. Well, one of the main benefits, I think, Dave, is, hey, if you sell your house and you rent now, then there's no home for the kids to fight over, right? That's one less thing your kids might be fighting over in your estate.
That's true. That's true. When the kids come visit, then they have to stay somewhere else. So,
that's another benefit right there.
You could sell the house, you could rent, and you can buy an RV and let the kids stay in the RV when they come to visit, so that you still have a little distance. So
that's if your goal is to cut down on your family visiting you in retirement.
That's a plan. Could work. That could work. And coming up, I want to talk more about real estate and how real estate affects retirees, and maybe some do's and don'ts there. And also, once again, how the interest rate environment could affect your income in retirement. I'm David Scranton, here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.
Welcome back to the Retirement Income Source, where it is all about the income. I'm Sarah Samuels, here with Dave Scranton. Today we're looking at interest rates and how they've affected the markets over the past month of November, including the stock market, the bond market, and we just talked a little bit more about how it's affecting the real estate market. Dave answered an Ask Dave question from Kyle in North Carolina, and really some of the benefits potentially if you don't want to own your home anymore, if maybe you want to downsize in retirement, the pros and cons of renting your home. So Dave, let's talk more about downsizing, because I think a lot of our listeners, they might be considering that as an option in retirement.
Yeah, and so the thing with downsizing is you're not getting out of the market, right? If you're trying to speculate that, hey, prices are high and the real estate market's going to crash and I'm going to sell my house and rent, well, then you're out of the market. And if that doesn't happen, if prices keep running upward, well, then
Gamble.
you're kind of stuck. That's right. And I understand prices are high and nothing goes up forever. But I know, for example, when I came down here in Florida, I remember in the late 90s and early 2000s trying to buy real estate, and the prices kept going up and up and up. And I didn't buy my house till the financial crash in 2008. And I waited for a long time. In retrospect, had I bought in 2000, I probably would have been better off. But so, that's the problem when you're trying to time it, right? But if you're downsizing, well, you're still staying in and not just taking money off the table. So the worst thing that happens, Sarah, if you downsize is the prices go up more and you could have gotten a little bit more for your big property, right? Even though you'd have to pay a little bit more for your small property you downsized to. So would it have been better to wait before you downsize? Maybe, but not necessarily. So even in that case, in that worst case scenario, right? Remember, if you sell now and prices go down and you downsized, hey, that was a good move.
Right.
You took the big pot of money off the table, you got back in with a smaller pot. If prices go up, well, you could have done better if you waited, but not really, because remember, bigger houses are more upkeep. So you have to pay more property tax, more insurance costs, and so on. So I would say I would not want to see anybody who really wants to downsize in retirement hold off because they're trying to speculate on market values.
Yep.
If that's your goal, then I think it's okay to go ahead and make that move.
Yep, it seems like another gamble, and really you're not going to know if it paid off until the end, and you can't really Monday quarterback it, right? What about real estate as an investment, though, Dave?
Yeah. Well, again, if you're our audience that's retired or close to retirement, you've got to realize a couple things. Number one, real estate is not a passive investment, okay? So it's not like, we manage money at our firm, right, where, okay, people just sit back and collect checks. And I always talk about how you can get over 5% net of fees in most cases today, 5.5, maybe even 6. So you got $1 million, 50, 60,000 of income. You don't have to lift a finger for it.
And you're not touching a principal either.
That's right. That's right. With real estate, same thing, but now you have to work for it. You have to either pay a property manager or you have to worry about property upkeep. So you have to take that into consideration. And also, to me, the cash flow needs to match that 5% or so level net of all expenses. So when you take out your property taxes, any interest on a mortgage, upkeep, if you can get more than 5% cash flow after those expenses, and even when factoring in a small vacancy assumption where we go unrented for a while, then maybe that's okay. But again, it's only okay for the person that wants to, that's willing to deal with the upkeep on the property.
Right. It all starts with goal setting, right? If that's one of your goals in retirement, it makes sense. But,
That's right.
Dave,
Yeah.
it's kind of funny you just mentioned the 5% income. Did you read our next Ask Dave question before
I did
the
not.
show? You did not? Okay,
Nope.
well, that's funny. So we have Charles from North Dakota. He says, Dave, you're always talking about how you can get 5% or more income on your retirement portfolio. But I looked deep into my 401k, and it doesn't seem to offer any of these options. So what can I do?
Well, Charles, I guess there's two things. I mean, the first thing is, why can't you get those options in your 401k? And part of it's because 401ks are built for people who think about why 401ks exist, Charles, right? Are they to hire people my age in your late 50s, almost 60, right? Is that why they have 401ks? No, 401ks are there to attract and retain employees. And most people aren't hiring people my age. They're hiring people in their 20s, 30s, and 40s. So they tend to have options that are more favorable for those younger employees, growth-based options. So, Charles, we always talk about that equation, total return equals income plus growth, right? TR equals I plus G. So you're looking at the I component and saying, well, why don't I have a lot of options with that generate a decent amount of I in my 401k? And the answer is because most 401ks don't have that. Most 401ks are more total return focused with a lean toward growth. Why? Because again, the goal of those plans is not to be benevolent to employees. It's to attract and retain good people. And the people they want to attract and retain are typically younger folks. So, Charles, this brings us to what can you do about it? Well, here's the good news. The good news is most companies have now realized that this is an option. This is a problem, I mean. They realize that they don't have a lot of suitable investment alternatives for people who are approaching retirement. So a lot of companies today offer what's called in-service rollovers, where you can actually take your money out if you're over a certain age. Most time it's 59 and a half. even if you're still working, you can roll it over to an IRA. So if you roll it over to an IRA, then it's tax deferred. There's no tax consequence there. But once you're in an IRA, it opens up the universe of options from an investment standpoint. Whereas if you stay in the 401k, you can't. So if you check your plan document, call HR, find out if you have the ability to make in-service rollovers. And if you do at your age, then that might be a solution. If not, and you find out maybe you're a couple years too young for the age at which your plan document allows those in-service rollovers, then you might just be stuck there picking the less of whatever evil until such time comes when you reach that age that the company allows this. Okay, so check with Human Resources, Charles, for sure.
Charles, thank you so much for sending in your question. And if any of our listeners out there have a question about retirement or your finances, even something that you would like to ask Dave, all you have to do is send us an email to askdave@retirementincomesource.com. You're listening to the Retirement Income Source, where it is all about the income. I'm Sarah Samuels here with Dave Scranton, and we're talking about interest rates. It seems like they're going to remain steady, like we've hit peak interest rates, the peak height of the interest rates. So what does this mean for the markets? What does it really mean for your retirement? And we were also just talking about 401ks and really why they're a tool for people in the growth stage of their life as opposed to the distribution stage, the retirement stage. So Dave, what else do our listeners and people nearing retirement, what else should they know about 401ks?
Well, great example. We can tie this together with our other question. We talked about real estate, right? Investment real estate. Well, you can't usually buy investment real estate in a 401k or an IRA, but you could do something called a REIT, a real estate investment trust, which is simply the stock of a company that owns rental property. So is it riskier than a bond? Sure. But it's still, in most cases, an income generating tool. Well, that's a great example of something that usually is not prevalent in 401ks. Okay. If you want to be more conservative, you want to buy bonds. Well, most 401ks don't have bonds. They have bond mutual funds. Right. And as a lot of our regular listeners know, there's a big difference in bonds and bond mutual funds.
They're not the same thing.
That's right. You own bonds, you have two assurances from the issuer, right? Number one, that they will pay you that interest payment for the life of the bond. Number two, when the bond matures, they'll repay the debt in full, providing, of course, the issuer hasn't defaulted or gone bankrupt, right?
Now, what about bond funds, Dave?
With bond funds, neither guarantee exists.
Oh, man.
They're both off the table. And that's why I even like to say that if any of our listeners were ever to study to become a financial advisor, they would find the definition of a bond fund as follows. The stock of a company that owns bonds. The stock of a company that owns bonds. See, and that's the problem. At least when you own a REIT, you know you don't own the real estate. You own the stock of a company that owns real estate, right? So you know it's a little riskier. But when you own a bond fund, a lot of people are lured into complacency to think, hey, well, these are like bonds. They're just as safe as bonds. Right. And really, you lose those two guarantees because it's a stock of a company that owns bonds.
Yeah. Now, when it comes to 401ks, Dave, I know they're mostly, they have mutual funds, they have bond funds. Are there any income options at all in most 401ks or not really at all?
Usually you have bond funds inside there. We usually do not have high dividend stock options, which maybe we should try to cover coming up a little bit because I think that's an important thing. But you have the bond funds. So that really isn't the ideal option. You don't have the real estate investment trusts. In most cases, you don't have preferred stocks, right? So you don't have these types of options. You often have a fixed interest fund, but I find that most times the rates on the fixed interest funds don't keep up with the rates, let's say, on bank CDs or with insurance companies on fixed annuities. So you might get lucky. One of our listeners might have a fixed interest fund that's paying 5 or 6%. That's a solid investment, but most are still lagging.
Yep. So a lot of people are probably asking, well, what should I do? How do I generate income, Dave? I like that 5% number you mentioned. That sounds good to me. So how do I do it exactly? Dave, you mentioned high dividend stock options, but I think we should talk a little bit more about ways that you can get income, especially in this current interest rate environment. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income. You're listening to the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with David Scranton, and we're talking about maximizing your retirement income. We know everyone wants to do that. They want to maximize their income, but you may be asking yourself, how do I do that in this high interest rate environment. So, Dave, we talked a little bit about real estate as a potential investment. We also talked about why you need to roll over your 401k, get out of your 401k, and get it into an IRA. So you have
in many cases,
in many cases, right? So you have all of the options available to you. But there are other ways that you can earn income, Dave, like high dividend paying stocks, for example.
Yeah, and that's another reason, like our last Ask Dave was, hey, why don't I have high income generating options in my 401ks? We talked about how there's no real estate investment trusts often in 401ks. There are no preferreds or mutual funds that have preferreds. Instead of individual bonds, they have bond funds and the problems related to those. But even the stock options typically don't have high dividend strategies. And here's the reason. Most stock fund managers, their biggest goal is to keep up with the Standard & Poor's 500 index, the Fortune 500 companies, right? They don't want to underperform. And the average dividend right now in the S&P 500 is really about 1.5%. And therefore, fund managers know that if they deviate too much from the index, there's going to be years where they kick its butt and they really do well and they outperform, but there's going to be years where they really underperform also. And one way of deviating significantly from the index is by having a yield that's much, much higher. Right now, we always talk about having a yield on some of our common stock strategies in the high fours, right?
Yep.
But that's triple what the stock market overall is paying. So, Sarah, that's a great example of where you're deviating from the overall market. There's years where you're going to crush it and outperform, but there's years where you're going to underperform. In fact, years like this, where the lower dividend stocks have outperformed the higher dividend stocks. Well, if you're managing a mutual fund, a stock mutual fund, maybe your investors will deal with 1 year of underperformance, but if you get 2 years in a row, they're going to start pulling money out of the fund. When they pull money out of the fund, you're the fund manager, guess what? It affects your bonuses, and you might even get fired and lose your job. So most fund managers simply don't have the courage, Sarah, to deviate in that way and to get into higher income stock strategies. So they might go to 2.5% dividend, but no one's going to go in that 4 or 5% range because, again, they feel like they're a commodity. They're competing against the index. They're not building customized portfolios for people who are retired and want income.
And I know that's kind of one of the big differences, right, with most financial advisors and what our income specialists do, especially our portfolio managers at Sound Income Strategies. They're actively managing all of these different assets and different investments, as opposed to an advisor who's just their goal is to beat the S&P 500.
Yeah, well, a lot of advisors are using mutual funds and exchange traded funds exclusively with clients. And so they have the same drawbacks in many cases as those 401ks did,
Right. Yeah, it's kind of the same thing. And it's all the growth mindset. A lot of advisors are still, Dave, as you mentioned, stuck in that mindset from the 80s and 90s where you can make a lot of return in the stock market. They're not making that transition, just like we always tell retirees and future retirees, hey, you got to make that transition to income. So I want to continue the conversation on interest rates, Dave, because I think it's extremely important for our listeners. And we have a new question here from Cheryl in Texas. She says, how have interest rates affected annuities?
Okay, Cheryl, great question. And Cheryl, I'm going to answer the question not for variable annuities because variable annuities have sub-accounts inside that work like mutual funds. So it hasn't really affected those other than to the level of market fluctuations. But fixed annuities, for example, we've seen some fixed annuities pay interest rates close to 6%. And now, Cheryl, you might say, well, gosh, we have some CDs that pay interest rates in the 5s. What's the difference? Well, the difference is a lot of CDs that pay a high interest rate are very short term. You want to go out 5 years or longer, you're not going to see a 5% CD anywhere. But in the annuity world, it's a little bit different. Why? Because insurance companies with annuities can invest a little bit longer term. So they've been able to take advantage of these high rates and lock in higher rates in many cases longer term. So instead of getting 5.5%, let's say for 1 year or for 6 months, you could be locking it in for as much as 5, 7, or 10 years. So it's affected annuities positively when you talk about fixed annuities. If you talk about indexed annuities, those types that go up when the market goes up but don't go down when the market goes down, it's affected those because it's enabled those insurance companies to give a little more upside potential when the market goes up, but still give the protection in the years the market goes down. So it's been actually a great boon for annuities where insurance companies are loving it because insurance companies are right now in a situation where they're writing more business now because the terms of these things than they've seen in certainly almost 2 decades at this point.
Well, Cheryl, thank you so much for sending in your question. And if any of our listeners have a question about retirement or maybe just the financial news and industry in general, you can always send us an email to askdave@retirementincomesource. That's SOURCE.com. And thank you for spending your weekend here with us on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton, and today's show has been all about maximizing your retirement income in the current interest rate environment. Plus, we've talked about other ways, Dave, that you can maximize your income really no matter what environment we're in, which is really the goal when you invest for income. So you just answered a question from Cheryl about annuities, and you mentioned the different types of annuities. So Dave, do you think people really should invest in annuities right now? Is it a good idea?
It really depends.
Yeah.
You know, as you know, Sarah, annuities are very controversial. Some people love them, some people hate them. Within the investor community, within the financial advisor community. But what it really comes down to is, what does an individual need? Annuities can guarantee income for an investor if that person's really conservative, or let's say if that person hasn't saved enough money where they can't live off normal interest and dividends. Annuities give people an opportunity to spend down some principal, but do it with a guarantee that they'll have the income for the rest of their life. So like everything else we do, Sarah, annuities have to be a personal decision based upon somebody's goals and their personal situation.
Well, when you offer customized portfolios, when you offer all of these different options, everything in the universe of income generating options, and you can really tailor things exactly to people's goals, which I know is one of the first things you really go over with a potential new client when they meet with you. It's figuring out their goals, because that is sort of going to be your strategy for everything else you want to accomplish.
That's right. And that's the problem with a lot of cookie cutter based advisors. I mean, it really is. And this is a pet peeve of mine. Because again, people say, advisors say, roll over your 401k, roll over your 401k. And then what do? They put you in a portfolio of mutual funds that weren't that much different from what was in your 401k, or a portfolio of exchange traded funds that really wasn't that much different. And they may say it's customized because you can mix those mutual funds in many different ways together, or customized, and that you can mix those ETFs in many different ways, but you could do the same thing in your 401k. Really, it's not truly customized like we talked about. When we talk about customized, as we talk about those individual bonds, so you can get those guarantees, that guaranteed income for the life of the bond and that guaranteed repayment of principal when it matures, providing, of course, that the company hasn't gone insolvent, right? Then you have preferreds, which are a whole different type of stock that we talked about that could pay a very nice income stream, usually higher than bonds, interest and dividends. And you have the REITs, you have even something called business development companies we didn't talk about today, high dividend stocks if you want to be more aggressive, and certain types of annuities if you want to be more conservative, But again, I think the biggest message, though, for today is to get people to understand that if rates have peaked, like most people think, then now might be a good time to lock in longer term rates. Don't go short term because you can get the same rate short term or even higher rate short term than long term. It might be a good time to lock in longer term rates because, we talked about this on a previous show. Retirement is a financial liability. And is it a short term liability or a long term liability?
Hopefully a long term liability, right?
God
30
willing,
years or more, yeah.
It's a long term liability. So you want to fund that with a long term asset. Trying to fund retirement with a series of 1-year CDs that are going to roll over each year is like playing a little bit of Russian roulette. It's not much different from what we talked about earlier in the show. Selling your house because you think real estate's high, and then sitting there and waiting for prices to go down to get back in.
Yeah.
It's the same thing here. If you're on short-term interest rates, you're betting that rates are going to stay this high for a while. And I think that's a risky bet to be taken right now.
Yep. Well, it looks like now, like you said, Dave, now could be the best time to buy into some of these income generating options. And of course, when you work with an income specialist, you're going to get access to all of those different options that are great for you. So we're going to talk about why now is the best time and how you can invest. I'm Sarah Samuels here with Dave Scranton, and you're listening to the Retirement Income Source, where it's all about the income.
And welcome back to the Retirement Income Source, where it's all about the income. I'm David Scranton here with Sarah Samuels. And today we're talking about interest rates, how interest rates, according to most analysts, most economists, believe have peaked for now. The next move for the Federal Reserve is likely to lower interest rates. And what does that mean for your money? So we discussed so far things like real estate and how it affects real estate prices if you're an investor or you're looking to maybe upgrade or downsize your home. Also, how does it affect 401ks and why 401ks typically don't have a lot of high income generating options inside there. And we also talked about why now might just be the best time in a while to lock in longer term interest rates, to lock in long-term rates versus short-term rates. Because Sarah, at the bowels of the interest rate environment 2-3 years ago, we were only able to get people maybe 4% net of fees. And if we can get 5 to 6 now, depending upon the person's risk tolerance, that's anywhere between a 25 and a 50% increase in income.
Right, and everyone can use more income in retirement.
Yeah, so people who thought 2 years ago they couldn't afford to retire might be able to, even if their money hasn't grown, just because their money can generate more income now. But again, only if you're locking in that rate longer term.
And Dave, I know our show is mostly geared towards those people that are a few years away from retirement and also currently retired. But for our listeners that maybe have 10 or maybe more years than that before they want to retire, why is now potentially a good time for them to also lock in more income?
Well, Sarah, it depends upon the person, right? Yeah. So first of all, if you have enough money that you think you can retire based upon today's income levels that I just discussed, then it might make sense to take some of that money off the table and have it generating income. If you don't have enough money and you still need to play a lot of offense and you're saving and you need a lot of growth and you have to be more aggressive, then that's a different story. But again, if you thought, I've got $1 million, I can't retire off $40,000, but now, gosh, I've got $1 million, maybe I could retire off 55 or 60, maybe it's worth considering. Because think about it, if you're 10 years out, there's a chance the market could be underwater 10 years from now. Okay, so let's say you're in that 401k, you're invested in something that pays a 1.5% dividend, like the broad stock market, right? You have $1 million, 1.5% gives you $15,000 a year.
Not enough to live on for most people.
That's right. And you hope the market's going to be up 10 years from now, and most of the time in 10-year increments it is. But not always. If we put this plan together in the year 2000, by 2010, your $1 million might have been down to $800,000.
That would have been painful.
Now, if you're down 20% 8 years later, right, 10 years later, are you going to want to sell at that big of a loss?
No, definitely not. You're going to lose even more money.
Right. So now you're stuck with $15,000 of income. So you might say, well, gosh, I've got 10 years to go, but what if I went to income today and I got $55,000 of income? Well, what we do know is if that $55,000 of income gets reinvested for the next 10 years, it's going to grow by 5.5% a year. It's going to be up to almost $90,000 of income by the time you actually retire. So now you're gaining your income more conservatively by buying more shares, by reinvesting that higher income level versus rolling the dice and hoping that the market's up at that time.
Well, it's a great strategy. It's a great way to look at it. And a lot of people are even more concerned, Dave, about, can I retire? You mentioned, hey, if you haven't saved enough, if you don't think you've saved enough, some people want to keep working in retirement. We've seen a lot more of that. People in their 70s. Some people have to keep working in retirement. And our next Ask Dave question has to do with this concept. So we have Carl from Arizona. He says, should I keep working in retirement if I'm worried I haven't saved enough money, or are there other options for me to consider? Okay,
Carl. Well, he's
saying, Dave, I need your help. Help me.
Yeah. I mean, if you don't have enough to retire, but you're really tired of working full time, for whatever reason you want to cut back, then working part-time in retirement to supplement your retirement income is a necessity. But I will tell you, Carl, it's not all bad. There's a lot of good news for people who work in retirement, even those that can say, I've got enough income, because working, for most of us, we go to work, and that's 8 hours a day. And sometimes we spend more time with our work families than we do with our families at home, right? And it becomes a way of socialization. It also becomes a way of expanding our minds. There have been studies that have shown that a good way to ward off dementia is to keep your mind active. So there's lots of good reasons to work, be they social, be they keeping yourself sharp, keeping yourself active, lots of good reasons. And it could be that, hey, you've got enough money, enough income to get by in retirement, but maybe you can't do all the fun things that you want. So I'd feel more comfortable, Carl, if you says, okay, I've done what you've told me in previous shows, Dave. I figured out what my I need income goal is, that I need to pay the basic bills, right? If I do nothing, if I sit home all day. And then I know what my I want income goal is, which adds on the things that I want to do because, right, Carl, you have more time on your hands. More time means, you're going to want to do more things. Doing more things means you're going to want to spend more money. It's going to cost more, right? Then if you say, hey, I've got enough income to cover the I need goals, then I'd feel even more comfortable with this idea of you retiring from your full-time work and working part-time. Why? Because now you're working for those I want goals. You're working for the play money. You're working for the fun money. Okay. But on the other hand, Carl, if you don't hate work yet, if you like it and you feel challenged, even if you're at an age where traditionally you think, gosh, people do retire by now, but you like what you're doing, then stay full-time, because you stay full-time, you'll make more money, you could save more money, and you can accumulate faster. So, Carl, like everything else we talk about, it really has to be a personal decision based upon your goals and what you're doing at work today.
Yep. Carl, thank you so much for sending your Ask Dave email. And if any of our other listeners or even YouTube viewers have a question for Dave, all you have to do is send us an email at askdave@retirementincomesource.com. And thank you for listening to us here on the Retirement Income Source, where it's all about the income. I'm Sarah Samuels here with Dave Scranton. And today we've been talking about interest rates. It looks like we're in the peak interest rate environment, what that means for the markets and how it's affecting your portfolio, plus some other income options that people really need to consider. Why now might be the best time to get into income if you haven't already. So, Dave, what do you think about this idea, with people working? Carl's not alone, right? A lot of people are still staying in the workforce by 2032. So that's about 9 years from now. The Labor Department is predicting about 1 in 10 people in the workforce will be over the age of 75. But there's some drawbacks, right? Like if you're taking Social Security and you're earning income, you might have to pay taxes. So what are some of the drawbacks, Dave?
Yeah, some of the drawbacks are taxes, right? Obviously, because when you get to that age, you've got to take Social Security by 70 under current law. You have to take required minimum distributions from IRAs and the like. So it does increase your tax bill. But remember, there's a lot of countries out there where the marginal tax brackets are as high as 70%. We're not there. And for most of our listeners, Sarah, they have, you're still keeping 70 cents on a dollar or so. Even if you're keeping 60 cents on a dollar, it's still better off. So what it really comes down to is, do you love what you do? Do you love what you do? Say you can afford to retire, right? Do you love what you do? Do you want to keep working? Is it part of what energizes you and challenges you? I mean, think about me, right? Can you ever imagine me retiring? I mean,
No.
seriously.
I have a hard time just imagining you sitting on a beach somewhere with a Mai Tai in your hand, just relaxing.
Because this is what challenges me. This is what's fun. Now, granted, I'm only 58. Who knows in 17 years at age 75, that'll be the same way. I personally can't imagine it changing, but then you build your work life around your personal life, around your personal goals. So you work when you want and you don't when you don't want. And as long as you have the money to retire financially, then you're always in the driver's seat. You always have options. Even if your current employer won't play ball with you working a flexible schedule or working part-time, there are other options, consulting and the like.
And it's about what you want to get out of retirement. We talk a lot about, are you moving towards something? Or are you moving away from something? You don't want to retire because you're tired of your job. You hate your boss. You really want to think about how to make a fulfilling retirement, right? Like you mentioned, Dave, if you've gotten all of your, you've had a lot of social connections, you've gotten a lot of fulfillment out of your work life, you have to translate that into retirement or you're going to be left feeling unfulfilled. And it doesn't mean you need a full-time job. People find that in volunteering and part-time jobs, maybe even caring for their families, but I think that people really have to think about that. It's not like your brain's just going to shut off because you retire. You
always have to be moving towards something in life, and that's the case. So the biggest thing is goal setting. I think it's a great way to finish up is to let people know that, you really have to sit down and take time and figure out, hey, what is it I want in retirement? And that takes time. You and your significant other or spouse sometimes have to sit down, do some goal planning. If you're not sure what you want, interview people. Like I always say, interview people who have retired, those that are happily retired, and those that are unhappily retired, because they can tell you what mistakes they've made that they might do differently if they could do it all over again. So like everything else, it's really a personal choice, and it's up to you to craft the retirement that you want. Then a good income specialist could take care of building, satisfying the income need. but they can't really help you with what you want to do.
Nope, that has to come from you.
Yeah.
So we hope you enjoyed this episode of Retirement Income Source. If you want to listen to this episode again or any of our past shows, all you have to do is go to retirementincomesourceradio.com and listen there.
And yes, of course, we'd love it if you share this with your friends, but more importantly, we hope that you're back with us next week, same time, same station. I'm David Scranton here with Sarah Samuels, and this is the Retirement Income Source, where it's all about the income.